Hello, it's Mark Shying, and thanks you for rejoining me. So now we go to our first presentation. So the research team here, which is 4 academics from University of Technology, Sydney, Professor Peter Wells, Dr. Lee Ma, Associate Professor Helen Spiropoulos, and Sebastian Onie. And their research looked at or is an evaluation of the impacts of the adoption of AASB 15 revenue from contracts with customers. Now, the presenter today is Sebastian. So, a brief background about Sebastian. So, Sebastian is an academic tutor and is enrolled in the UTS PhD program in accounting. Sebastian holds a Bachelor of Business in Accounting and Finance and a Bachelor of Business Honours in Accounting. Sebastian's research interest is in the implementation of accounting standards and the economic impact of those standards. Currently, he is investigating the economic consequences of IFRS 16, leasing standard, within the Australian setting. So thank you, Sebastian.
Thank you very much for the introduction, Mark. As mentioned, my name is Sebastian, and today me and my team will be presenting our findings on our topic, which is the evaluation of the impacts of IFRS 15, revenue from contracts with customers in the Australian setting. Just bear with me for a sec. Oh, there we go. And so the motivation is pretty simple. As you all know, with every new accounting standard, the IASB is required to undertake a post-implementation review of said standard and review on whether standard achieved its objectives and whatnot. And in doing so, we aim to provide support for that or evidence. There's a couple of studies that have speculated the impacts of IFRS 15, and in doing so, we like to add a bit to that in a more empirical side. More generally, we also look at the insights into how firms transition to new accounting standards. This is important as well to standard setters who are concerned with the flexibility in transition methods that firms have, as well as the consequences of the flexibility given to those firms. And when we thought about it, we narrowed down to 4 main questions when approaching this study. First and foremost, how did firms transition to IFRS 15, and what were the impacts of IFRS 15? Number 2, was IFRS 15 appropriately targeted? And so was IFRS 15 able to identify firms that had issues in their revenue recognition practices? Number 3, for firms impacted by IFRS 15, did it improve the relevance of financial reports? And so did IFRS 15 fix the issues that were identified previously in question 2? And last but not least, did IFRS 15 resolve differences in the relevance of financial reports? And this is more so because if in question 2, if there were firms that had issues with their revenue recognition practices, then hopefully those issues would have been resolved and we could virtually tell no difference between the firms from each other. In our design, we look at the incremental information content of earnings, and by comparing the incremental explanatory power of or the explanatory power of these 2 models with and without earnings. And so we look at the impact of IFRS 15 by the differences in explanatory power when earnings included. But as everyone knows, this is a revenue standard. So why earnings? The issue here is that although IFRS 15 introduces a new method in which revenue is recognized, it also introduces as a difference in the way expenses may be recognized as well, or the issue of expense recognition. In respect to that, then we may see firms that may have increased revenues in their restatements, but then that would be accompanied by an increase or an offset in expenses, which would mean there would virtually be no impact. If we were to only take the revenue numbers, then this would potentially overstate the impact of IFRS 15. The second issue is that if we were to try include revenue in our model, then we would have to include other variables and controls to account for the different ways every firm accounts for revenue or their business models. And with this was not possible with the number of observations and the availability of data that we have. For our sample, we started with the ASX 300 over 3 years, in which we look at 2 years before the transition and the year of transition. And for our exclusions, we primarily exclude firms where their revenue recognition practices would be dictated by other standards aside from IFRS 15. We also hand collected the impact data in which we looked at how IFRS 15 impacted the financial statements. So we start off with 300 and we end up with 94 for firms that we evaluate for the transition. We then only include firms with a P ratio of less than 30 and market book ratio of less than 10, because for our analysis, these are firms where we believe their earnings and book value would still be relevant for users. Hence, we end up with 66 for our further tests. In addressing the first question on how firms transition to IFRS 15, we approach it with a purely descriptive method in which we look at the way firms transitioned. In transition to the new standard, they had two choices. They had the cumulative and the retrospective. The cumulative approach simply allowed firms to make adjustments to their opening retained earnings, and to the extent that would be the bare minimum amount of disclosures that they needed. And that does affect our capabilities of analyzing these firms or evaluating the impact of IFRS 15 by us as well as users due to the lack of information or lack of disclosures. Unlike the retrospective approach, where firms would have to restate their reports as if they've always been reporting under the new standard. And here as well, we show the impact of transition for either methods as well. So just to show, so out of those 94 firms, 51 used the cumulative approach, 28 chose to use the retrospective approach, and 15 did not disclose on what method they used. And so as you can see here, most firms elected to choose the reduced disclosure methods in transitioning to IFRS 15. When we cut down to our 66 sample, we can see here that most firms had no impact. Only 5 had an upwards adjustment to their retained earnings due to the standard, and 18 had to readjust their opening statement or opening retained earnings downwards due to the standard. When we look at the actual impact of the standard, though, here we can see that for the impact of firms, if I may redirect your attention to the bottom right panel, the changes were highly immaterial for the impact up, and hence why we exclude that in our later tests. But overall, as we can see, for the overall impact of the standard was a downwards adjustment to retain earnings. Again, most firms had no impact in this case, only 18 an impact down and 5 had an impact up. And what this tells us is that in terms of disclosures, it was highly variable in that we had firms that had immaterial impact. And for those firms that had immaterial impact, they would make immaterial disclosures that weren't exactly relevant. But then you had firms that had high impacts or firms that had material impact that would choose to use the reduced disclosure methods. With this as well, this tells us in terms of transition methods that it may be important to have lead times that allow firms to develop systems to transition, and that the simpler reduced disclosure transition would be a cheap, efficient method for firms with immaterial impacts. This, however, should be restricted to firms with immaterial impacts. And with the sense as well, I'm sure the standard setters would have intended for firms with limited or immaterial impacts to use the reduced disclosure method. But then in this case, you had both ends where firms, as I mentioned before, would use the retrospective method regardless, and firms would use the reduced disclosure method with material impacts. Due to this fact as well, our tests may lack power due to the fact of the high variability in the disclosure of firms, along with the materiality of the standard, in which a lot of the impact was highly immaterial. And that begs us to ask the question on whether a revolution of accounting standards was needed, because this was an accounting standard that took a lot of time. It required a lot of resources, but the impact was limited. And for those limited impacts, there really wasn't the effect wasn't really that great. And whether did we actually need a new accounting standard, or whether we should have just worked on what we had, that is a question to be asked here. We get on to our second question, in which we ask on whether IFRS 15 was appropriately targeted. And so, was IFRS 15 able to identify firms that had problematic revenue recognition practices or earnings? And with this is when our pretest, we compare the incremental information content of earnings on the bottom. And as you can see here, for the impact down firm, their incremental information content of earnings is much lower than the firms that had no impact prior to the implementation of the standard, where the no impact had a incremental R squared of earnings of 40%, and the incremental R squared for the impact down was 14%. So, and this tells us that the standard was able to identify firms that had troublesome earnings. So that's a good start. But let's move on to the next question. Well, for firms impacted by IFRS 15, did it improve the relevance of financial reports? And this is a pre and post test where we compare the incremental R squared of earnings before and after. And as you can see here, for the no impact subsample, there was a reduction in the incremental R squared of earnings by a substantial amount. This unfortunately highlights potential issues with our design and data, which we are unable to address at this current moment. For the impact down subsample, though, as you can see here, the incremental R squared of earnings that was lower in the pre-period compared to the no impact went down, but not as much as the no impact subsample. What this suggests is that while there may be some resolution of some issues with the previous revenue standard, or the way the earnings of these firms, well, not all of them were potentially resolved. But again, we take this with in this interpretation as caution due to the results for the no impact sample. So what this tells us is that there was really no evidence that IFRS 15 improved the relevance of earnings for impacted firms. But was this actually a surprise? Well, the thing is, we know that with accounting standards, accounting standards do have real consequences. And what we mean by real consequences is that firms may take actions in order to reduce the effects of said standards or avoid it completely. One example of such a firm is InvoCare, where under the old revenue standard, they were able to identify, under their contracts, they were able to identify their revenue upfront. With IFRS 15, though, and just to be clear, InvoCare was a firm that had to reduce their opening retained earnings, but they used the reduced disclosure method, or in other words, the cumulative approach. And essentially, under the new standard, they were able to, they now would be recognizing revenue at the end of the contract. What this meant was that they would be able to recycle their revenues and profits for the next few years. Now, again, revenue that was previously recognized. And so, again, we wouldn't give it a pass for this test. But for question 4, we finally asked whether IFRS 15 resolved differences in the relevance of financial reports. Whether there was still any issues or those issues are still gone, this is what this question was meant to identify. And with here, we can see that although there may have been some resolution of issues for the revenue recognition practices, not all those issues have been resolved, and there are still differences in the incremental exponent or spread of earnings for both the no impact and impact down sample, even during the transition period. And so this tells us that the standard is still, unfortunately, a work in progress, and there are still some issues that the standard needs, that there are some issues that the standard was not able to address. One sec, apologies. Now, with all that out of the way, we've had a accounting standard that took a long time, that firms had to spend a lot of resources. It impacted only a limited number of firms. And for those firms that were impacted, the effects may have been greatly immaterial. And identified by our tests, there were still some issues with their revenue recognition practices, and that and those issues have not been resolved. And so, what we must say collectively, in the words of William Shakespeare, the standard was much ado about nothing. Thank you very much, guys, and I'll hand it over to whoever's in charge after this.
Thank you, Sebastian. Thank you very much for the presentation. Now, what I see as one of the real highlights of the research forum is the discussion, that is the facilitated discussion with the panel. And so for this session, we have our facilitated discussion with 4 panelists. So what I will do is I will give you some background about each of our panelists, and then about our facilitator, and then I will pass into our facilitator, who will then facilitate that discussion. So the panelists that we have with us today are Sean Hughes. So Sean commenced as an ASIC commissioner on 1st December. He was most recently the Group General Counsel for Tabcorp, and before that, Chief Risk and Legal Officer at UniSuper. Sean has held leadership positions at National Australia Bank, ANZ, and was a partner of the law firm Herbert Greer and Rundle. Sean was Chief Executive of New Zealand's Capital Markets and Financial Services Regulator, the Financial Markets Authority from 2010 to 2013, and he had previous senior positions with ASIC, including from 2008 to 2010 as Senior Executive Leader for Corporate Governance and Corporations. Our next panellist is Martin Lawrence. So Martin is a director and co-founder of Ownership Matters, an Australian governance advisory firm working for institutional investors. Prior to Ownership Matters, Martin was head of research for Australia and New Zealand for ISSS, and he worked for BT Financial Group's governance advisory services, and for 4 years was a finance journalist. Our third panellist is Tracy Driver. Tracy was an audit partner at KPMG based in Sydney until 3 months ago, or 2 months ago, September 2021. Tracy has 26 years of experience providing financial statement, audit, internal controls, and accounting advisory services, and was a partner in the Technology, Media, Telecommunications and Services Audit Division. Tracy has worked for KPMG in UK, US and Australia, and currently is consulting for a high-growth software as a service business on revenue recognition and other accounting policies. So that's our panelists for this session. Now, our facilitator is Alison White. So Alison is AASB Deputy Chair, and she is leader of the National Accounting Technical Team in Deloitte's Assurance and Advisory Division. Alison has over 19 years audit and accounting advisory experience in Australia, Hong Kong and South Africa, specialising in the resolution of complex accounting issues. Alison is a member of the Deloitte Global Expert Advisory Panel on Leases and the Property Council of Australia's National Accounting Roundtable. Alison's areas of specialist expertise include leasing and off-balance sheet structures, revenue recognition, impairment of assets, mergers and acquisitions, and asset sale transactions. So I'm sure all of our attendees would acknowledge the skill set of our panelists and of our facilitator. So I now hand to Alison for this part of our forum. Thank you, Alison.
Thanks very much, Mark, and thank you to Sean, Martin and Tracy for being here today, and thank you very much to Sebastian and Peter for their presentation. On a standard that is very close to my heart, and in many ways actually a really tough standard for both companies and auditors to implement and audit, because the previous revenue standard was, I think, all of 13 pages. When this came out, the initial pages were several hundred, but grew quite rapidly as everybody developed guidance, and the guidance extends to over thousands of pages right now. So lots and lots of effort went into this, and I was interested, Sebastian, in your comment about much ado about nothing. Certainly we've had many debates around how successful the standard has been. So to get started, Sean, if you don't mind, I might start with you. As a regulator, you and your team would have reviewed many financial statements as part of the financial statement surveillance program that ASIC runs. It would be really interesting to hear some of the observations you've had of companies who are applying AASB 15. And probably, if I ask just a follow-up to that, is what would you like to see companies doing to really improve the quality of their reporting?
Thanks, Alison, and good morning, everyone. Thank you very much for inviting me to join the panel. It's been a very interesting discussion so far. So look, as I think all of this audience would understand, ASIC undertakes an ongoing inspection and surveillance program in relation to financial reports for listed entities and other public interest entities. And we do that on a risk-based way. And that's because of the size of the market that we have to cover. Now, over the last few years, the top 3 subjects of inquiry of letters to companies on their financial reports have included impairment of assets, expense deferral, but importantly for this morning's conversation, revenue recognition. So it's up there with the top 3 issues that we are following up on a regular basis. As to AASB 15, a couple of observations that we would make. The first is that the adjustments on transition were not all as a result of changes to accounting standard requirements. In at least 2 cases where we questioned the company's accounting treatment, we found that the treatment was not in accordance with the previous accounting standard, even though the entities responded by presenting the resulting changes as though they had arisen from the early adoption of AASB 15, and we published our findings in that regard. Another observation we would make is that an improvement in reporting revenue due to specific new disclosure requirements in AASB 15 was evident, but importantly, there still is room for improvement. We think that companies should disaggregate revenue streams and explain the accounting policy for each stream with regard to the nature, the amount, the timing, and the uncertainty of revenue and cash flows as affected by economic factors. We've raised these matters with companies through our surveillance program over the last few years. And then finally, as a word of advice or guidance, we think that companies should tell the story better by explaining the underlying drivers of revenue for each part of the business in the operating and financial review, as well as future prospects. Back to you, Alison.
Thanks, Sean. So interesting regulated view, and clearly revenue being such an important metric for companies and not telling their story to the investors. Martin, I might move to you. What were your observations as a user in terms of the adoption in 15? And do you think the information that was disclosed did improve quality?
I suppose the first thing I'd say as a user was it was quite gratifying that for a lot of companies, AASB 15 was much ado about nothing. That you didn't see this very significant marking of revenue back to a more conservative approach. The companies that were heavily affected by AASB 15, who had significant retained earnings restatements down, were not really surprises. I suppose you could say it that way. There were some really quite significant ones, tech ones being mentioned, Invoke areas. The only one I've seen which actually basically changed their business practice to respond to the standard to enable them to keep recognising revenue the way they had been. To pick up on something Sean said though, the greater granularity you got on revenue disclosures as a result of AASB 15 was really useful for some companies, like really, really useful. Even just that distinction that you see in a lot of accounts now between point in time and over time revenue. If I think of an example of a company like corporate travel, which has 2 parts to its revenue, and one of them is a sort of quite straightforward point in time recognition, but then they have these accruals to do with meeting targets for sales. And they actually separated out that category of revenue when they adopted AASB 15. And so that's the bit that there's the most judgment, if you like, in determining what the quantum is. And so separating that out was really quite useful from an end user perspective. The one thing I would flag, and I've been surprised this hasn't had much more of an impact to date than I expected, actually. It was where I thought companies might attempt to address, from a P&L perspective, some of the restrictions on revenue recognition they encountered as a result of the new standard, which was this greater ability to capitalise expenses, commissions being the obvious one, or incremental costs to winning revenue. You've seen that happening a little bit in a handful of companies, but not to an enormous extent. It's more been around the edges. rather than really material changes to the P&L. But overall, the standard has been, probably because there wasn't huge disruption to company accounts in most cases, and tighten things up a bit. It's been well received, I suspect, by most investors, unlike, say, one dear to your heart, Alison, AASB 16, where I'm yet to find an investor say a single positive thing about it.
And I think Sebastian said he was doing some research into those economic effects, so that will be interesting to hear about at a later stage. Thanks, Martin. I mean, it's interesting to hear that to a large extent what you were expecting those companies to have the biggest impact were those ones that had the biggest impact. Tracy, I think we as auditors did see a number of challenges with adoption of the standard. What were your observations that you experienced?
Well, I think it was very much industry dependent, Alison, because it was quite clear, I think, in the early stages that some industries were going to be much more impacted than others. So for those industries where there was going to be a significant impact from an audit and from the company's perspective, a huge effort and a long time preparing for the impact and the implementation of the standard had to be undertaken. So really some really significant projects and a lot of time put in, because it did really involve going back and getting into the nitty-gritty of all of the contracts, and the company and their finance team reading through all these contracts in a lot more detail, and then subsequently the auditors coming in and doing that work over the top to make sure that you were following the standard's 5-step process. So because the standard's quite prescriptive in the way that you have to go through the process, there was a lot of work there. In addition to sort of looking through the accounting, it also meant that companies had to potentially change controls and change their processes as well as they moved forward with the adoption, to make sure they were picking up all of those 5 steps. So it wasn't even just around necessarily the accounting, it was actually, a change that impacted not just finance, but potentially the sales teams and other elements of the business. So it could be quite far-reaching, dependent on the industry. But it was quite, as I said, industry dependent. So for example, companies that have complex contracts, which are longer term or which might have multiple elements in them, were much more impacted than FMCG type companies that were just, shipping out goods. And then I guess from an audit perspective as well, and the company's perspective, the other elements of the standard which were challenging are the areas where you need to think about making estimates. So if you've got those multiple element arrangements, you have to allocate the revenue on a fair value basis to each of those elements, which is complex and can require some judgment. Loyalty point arrangements were complicated because you have to estimate breakage when to recognize revenue, anything with contingent revenue, variable revenue, all of those really specific areas that are called out now under AASB 15, which were much grayer in the under IAS 18. That was an area that had a lot of focus, where anything where there was an estimate element to it was difficult from the company's and the auditor's perspective. And those things need to continue to be looked at now on an ongoing basis, and those estimates get changed as contracts get worked through. So it wasn't just a one-off aspect, that's an ongoing aspect that we are dealing with as we continue to apply the standard. So yeah, those were really the most challenging areas, I think.
Yeah, and I think I suppose there was value from that as well.
Oh yeah.
What sort of value did you see?
Yeah, I think that previously, because there was differences in practice potentially with the way that some of those more judgmental areas were applied across industries or across companies. This has tightened that up and provided more consistency because there's a more detailed level of guidance. So I think that's good. And then, as everybody's mentioned, like the disclosures, if those were done well, I think that's very useful in terms of understanding what the revenue drivers are, how the company derives its revenue. So and just going through the process, I think just to really look at the way contracts are worded and contracts are drafted and what the sales teams are actually offering, and is that, you know, commercial, and is that the best way to you know, make those sales on complex contracts. You know, I think that was valuable for the companies themselves as well.
And I must say, one of the big benefits I got, which is similar to what you were saying, was that ability to actually go and re-look at the contracts, make sure everybody understood the commercial substance, both as an auditor and for the client themselves. I think there were a number of companies who realized that their customers could actually cancel their contracts at any time for convenience, and that was not something necessarily that the whole business was aware of, and companies started to think about what that meant, and is that actually what they wanted in their contracts. So Sean, I do tend to agree with you. In a way, it was an opportunity for companies to revisit that accounting and to re-level set, because the previous standard had been there for such a long time. So yeah, interesting one. I think the other interesting point was we saw coming out of Europe that a number of the companies who were significantly impacted actually did a press release or an investor presentation on the impacts of the revenue standard. And I mean, it wasn't many, but they were just those that really had significant impacts. Sean, I'd be interested from your perspective, whether you think the market was sufficiently informed of the potential impacts as they should have been.
Yeah, Alison, I think we'd say the jury's a bit out on that one. We were a little surprised, given you know, the standard was issued in 2014 and applied from 31 December 2018 and 30 June 2019. But there seemed to us to be a lack of preparation around the possible impacts. And our particular concern related to the lack of disclosure around the estimated impact in that year prior to transition. We do think that companies should have had the information available to them as to the need to adjust comparatives or retain profits in the following year's financial report. So I think that lack of preparedness for the implementation of the standard was a concern. As you would expect us to say, we think that directors and preparers of financial reports must understand the impact of new accounting standards, and they need to have systems and processes in place to support reporting under those new standards and to have a very clear transition plan and the resources and the systems to support that transition plan. You know, we've talked a lot already this morning around you know, how it appeared to the ordinary reader of the accounts. From our point of view, we just don't think that there was enough evidence of that well preparedness, given the lengthy period of time that people had to get ready.
And so getting those disclosures out in the year prior to adoption would be helpful. Martin, did you have a perspective on that?
I was thinking actually about, I mean, I can think of one Australian company which had a full-on presentation about the impact of the standard. It was a company that has been mentioned and was, I guess, known for its unusual revenue recognition policies. It had, as an item on its balance sheet, non-current unbilled revenue, to give you an idea of some of the interesting revenue recognition it got up to. It, at the same time as it announced that AASB 15 was going to have, you know, changed the way that it recognised revenue, making it harder to pull forward multi-year contracts. It, at the same time, announced it was going to start capitalising software expenditure, which it had never done before. And so its P&L impact was a washout. They managed to restore, through capitalising software, the impact of delaying revenue recognition. What was really interesting in that case was I'm pretty certain that they didn't do the retrospective disclosures. They just adopted it with retained earnings, bang, huge hit, and then on into the new world. But I guess my sort of observation about the standard would be that because there are only a few companies that seem to be very highly affected, the ones who were very highly affected, I can think of one example which confused investors enormously, which was Downer, the contractor and sort of service provision company, which had a major restatement to retained earnings on a particular acquired contract. And that confused investors enormously. And they spent a fair bit of time on it, but I think it was that multiple impact of, it was something they had acquired. And so they did it through, it was very hard for investors to work out whether, hang on, are you doing this through acquisition accounting, or are you doing it through AASB 15 restatements, or exactly what's going on here? And that's one example I can think of where there was where investors were saying, where a company's disclosure of the impact was perhaps not as great as investors thought. Even if you went back to their 2018 accounts, they had already told you this was going to happen. They just hadn't told you it in the management presentation.
And did you have a perspective on whether full retrospective or the modified retrospective with not restating them comparatives makes a big difference to you as a user?
I suppose it makes a big difference if there's a major impact. Now, a company which did not have a major impact but did do full retrospective disclosure was corporate travel, where you got improved quality of disclosure. Domino's was a similar company. And this was that kind of classic case where you had companies that would have, so Domino's, when it sells a new franchise or renews a franchise agreement with a franchisee, there's certain upfront fees associated with that. And under AASB 15, those became recognised over time. It was a modest, very modest negative to earnings, but the retrospective disclosure there was really helpful because it allowed you to separate out the impact. And I'd say that was an example of a company deciding to help itself by giving that additional information. If it was a company where the impact was, a $20 million hit to retained earnings in a company that makes $300 million a year, it probably wasn't something that you really looked for. It was really the high impact companies where you really wanted that retrospective disclosure to work out what was going on. And then there were some companies where it did actually help you understand their accounts better, which did it anyway. And that was really useful.
And Tracy, did you see from your experience whether there was a particular reason which led companies to go full retrospective or modified retrospective? What from your experience was a really key driver behind that?
I saw most people opting for modified retrospective because I think they just thought that was, it was just an easier way to go. Either, you don't have long-term contracts and therefore it's not going to be like this huge impact, or if you do have longer-term contracts, then how many years are you actually going to go back and wade through all these contracts? So I think, in both of those kind of scenarios, it was probably easier to do modified retrospective, and that's what I saw companies opting for. We've got kind of the same situation on the leasing standard where you had these choices of how to transition. I don't know that that's particularly helpful for anybody because, it does lack that comparability and would make it much harder for the users when you're, comparing apples and oranges. So yeah, I don't know that having a choice is really is helpful to anybody.
Sorry, can I just jump in here? On the AASB 16 standard, the number of companies who did modified retrospective and claimed increases in EBITDA in their first result presentation immediately afterward was really quite noticeable. And so that was a standard that had, even if it didn't have a big impact on the overall P&L, it had a very big impact on where things fell in it.
Yeah. And
so I think modified retrospective, not allowing modified retrospective disclosure for that particular standard would have been fantastic. I don't quite know how you design up the materiality requirements though for something like AASB 15 to say above this point, you have to do modified, you have to do full retrospective.
And what the standards had actually tried to do for 15 was actually to say, if you're going modified retrospective, then you need to give more disclosure on the impact in the current year. So what would revenue have been if you'd done the old standard in the current year, and what was it if you did it on the new standard? But I think the practices of the extent of that disclosure was probably fairly limited, but coupled with the fact that actually there weren't a lot of significant impacts. That was, I think, how the standard setter thought it would be helpful to provide some level of comparability, which of course they didn't do with the leasing.
I think on the clients that I was working on at the time from an audit perspective, I actually just glanced at one of the 2019 accounts this morning to refresh my memory how they did that. But you know, they certainly did do the whole sort of, you know, what a restated P&L and balance sheet would look like. This was you know, this is what would have looked like. This is what it does look like. So yeah, I kind of did see companies going to the effort for that, to, I think, for their own benefit, to explain what these adjustments were to the market. But yeah, I mean, I think that made it a lot clearer to put those disclosures in, certainly.
And Martin, just on one of your comments you made earlier around, it was quite interesting around the cost capitalization. That was something actually I was quite pleasantly pleased to hear, because that's something where the standard set has actually really narrowed what could and couldn't be capitalized.
Yeah. Yeah, it was the company that had that stopped recognizing non-current unbilled revenue as a result of the adoption of AASB 15. They have since started capitalizing a lot more commission costs as well as software to make their P&L. But to pick up on something I think that was implicit in a lot of the things that have already been said by Sean and Tracy and yourself, Alison, standards can only go so far, and then a lot comes down to the individual interpretation by management and how willing an external auditor is to say, well, no, you can't do that, or right, you can. And you can write the best, toughest standard in the world, but without that additional step, the standard will always be interpreted by particular management teams who have made sure they've got an auditor who will let them do this in a way that is most advantageous for them.
Yeah, so true. That's probably a good segue into quality. Sean, what is ASIC doing to try and make sure that the quality of financial reporting by management and directors is improving?
Yeah, thanks, Alison. So this has been a focus of ours really for reporting periods going back as far as 30 June 2010, right through to the most recent review, 31 December 2019. And our work in terms of our risk-based surveillance work in terms of financial reporting has resulted in material changes for about 5% of those financial reports that we reviewed. As I indicated earlier on, the three most significant areas for changes to financial reports have been revenue recognition, impairment of assets, and expense deferral. Now, since the 1st of July 2014, we've also been public around why we have taken a particular view, and we've publicly announced when a company makes material changes to information previously provided to the market following inquiries by ASIC. So we want to be as transparent as possible. And obviously we want to share the information around the market so others can learn. Now, it's true that sometimes our inquiries do not lead to material changes, but they still may lead to quality improvements. And we think that's fine. We think that's a good thing. Because improving the quality of disclosures of, for instance, revenue accounting policies and further disaggregation of revenue streams means more information and more transparency for investors and other users. Of course, what we do is we say to ourselves, well, we're making inquiries of companies to see whether, in fact, they have disclosed enough information in their financial reports so that we can properly understand the transactions that are being reported. And we think that if we don't understand the way in which those transactions are being reported, it's a fair chance that investors and other users of the reports will have the same difficulty. So from our point of view, it's just continually about improving the quality of the disclosure and making sure that it is as transparent as possible. Another way that we go about trying to improve the quality of financial reporting is by being proactive. And we issue media releases in terms of our focus areas for financial reporting prior to the main June and December reporting seasons. Again, these are deliberately targeted at directors, preparers of financial reports, and auditors. And we're really sending out a sort of a headline warning, if you like, or at least a publication to say, these are the areas that we're going to focus or zero in on. So be prepared. And then there shouldn't be too many surprises. And then, of course, since the outset of the pandemic in 2020, we've also supplemented those sorts of publications with frequently asked questions on the impact of COVID-19 on financial reports and audits. And this is intended to provide additional information, both to support preparers, but also to assist readers in understanding our particular take on an issue. And this, of course, is all in addition to our standard regulatory guides and information sheets. And as you'd know, Alison, we did publish a specific guide and statement as to the application of AASB 15 as well back in 2018. Thank you.
Thanks, Sean. And I personally have found that the publishing of the FAQs in particular through this, what has been quite a difficult period, has been really useful for us as auditors, but from our clients as well, to understand where your focus is and what your expectations are. So that's been really good. Maybe moving on out of this, Martin, what do you think are areas in which the standard setters could improve the revenue standard as they go into their post-implementation review over the next couple of years?
I personally, I think the more time I spend looking at company accounts, the more I come to have more sympathy for US GAAP and its general reluctance to allow anyone to capitalize anything. And so the ability to capitalize commissions, I understand the accounting 101 principle. I think the temptation and those incremental costs to winning a contract, I think the temptation it creates is not worth the matching of revenue to expense that it gives. And I'd say for 99.5% of listed companies, it would make no difference. And so that's one particular one I'd like to see them address. I think, to me, to touch on something I said earlier, the standard itself, I think, is a good standard in that it forced a more granular approach to revenue and also a more conservative one. And I think those are both things that investors would prefer. A company will always tell you what it thinks its annualized revenue is if it's getting valued on a revenue multiple. It's up to the standard to allow you to mark that to reality. I think more to touch on something I said earlier, greater focus on the actual nuts and bolts process around that conversation or match between the auditor and the client. And I don't quite know how you do that. I know there are auditing standards and audit regulation, but to me, that's an area where I think a lot more attention would probably give us better outcomes on revenue than on, say, the actual standard itself. Absent my call for them to prohibit capitalization of those expenses.
And I think what's interesting is we find that when investors are calling for information, that companies respond really well to that. Yeah. I think the importance of your voice in that is also really, really valuable and important.
Yeah, and sometimes you just see things. I can think of a company, a software as a service company, that has been in the news a lot quite recently. And one of my colleagues did a lot of work on it in the process leading to become familiar with it. One of the questions he kept asking them was, you actually tell us that 20% of your revenue, of your deferred revenue, is recognized over 2, 3, 4 years, and yet all of your deferred revenue balance is current. Why is that? And after 6 months of continually asking the question, finally you got that recategorization between the two. So yeah, companies do respond when investors ask them and tell them, look, this will help you.
Yeah. Yeah, absolutely. I've seen that in a number of scenarios. Tracy, what would your advice be for the standard setters from the challenges that you've seen?
Yes, I was pondering this yesterday. I think, as you said, IFRS 15, for example, was a much longer standard than what we had before. However, what then happens over the top of that, and as I'm sure you're very aware, Alison, is that the Big Four then create, or the accounting firms then create a cottage industry of guidance, which is a 700-page book on revenue recognition generally. There's another 700-page book on software and SaaS revenue recognition, sitting across all the accounting firms. So, there's kind of this balance between obviously what the standard setters can put in the standard, but then you get faced with this library of other guidance that gets out there and sort of almost becomes the reality of what's happening in practice, and how is that overlaid. So that interaction, I think, is really interesting between what's enough to put in the standard for the standard setters, and then how that becomes interpreted with all these specific real life examples. And I suppose that sometimes when reading the standards, I do wonder whether they've taken on board the input from what is going on in reality. I think in today's world, obviously things are moving so quickly, especially just in around the way that we use technology, because technology is impacting every company now. It's not just IT companies that are impacted by technology. It impacts across the board in terms of what everybody's doing. And I do feel, not even just with revenue, but with a lot of the other standards, they're nowhere near up to date with the way industries are now operating in reality. So I think there's been some attempt to address some of those issues by the international bodies. So, for example, with the IFRS agenda decisions, but that's also kind of a fascinating conundrum that we all find ourselves in, because if you think about, as Sean mentioned before, AASB 15 or IFRS 15 was put out in 2014, and people had 4 or 5 years to put in place processes and think about how to implement that standard. And now we're getting these kind of last minute IFRS agenda decisions that come out, which are supposedly niche kind of issues, but in fact can have huge impacts. And then you're supposed to suddenly implement them immediately, which is near impossible, to be honest, in some situations. So there seems to be a bit of a disconnect, I think, at the moment between these huge mammoth projects, which they take years to finalize. We're almost out of date by the time they finalize them. Then you have years to implement, and then this over-the-top guidance that everybody's supposed to just kind of jump and resolve the issue within 5 minutes. So it's a kind of interesting world we're living in now, and I do think that's a result of the way things have changed so rapidly over the last 5 years or so.
And I mean, that's one of my areas. I think the IFRS agenda decisions are making it really hard for companies, and I think because what those agenda decisions are doing are effectively interpreting the standards that companies are applying, because there's discrepancy in practice and different views. And if every 6 months we start having new decisions and companies are continually having to change their policies for whichever standard, I think that becomes problematic for companies. And I think it's just that continual change I'm not sure is particularly helpful, frankly.
No. I mean, I think in the past, some of those matters have been, as I say, quite niche and not so widespread, but the last couple have been quite complicated and have impacted a lot of companies. So I think moving forward, it's just, I think the standard setters are going to have to find some balance between that level of detail they put in the standards, a quicker process to get out a new accounting standard if they want to put a new one out, and then balancing that with thinking through how they actually allow companies to implement these IFRS decisions.
So, I mean, I might just add my final one on there. I think the disaggregation of revenue, which both you, Sean and Martin mentioned, I think for me, that's one where if you get that right, you can really make it clear what you do and what your key drivers are. And particularly when I look at financial statements, I always look at to see whether the major revenue streams have an accounting policy attached to them. But certainly there's significant diversity in practice. And I think it comes back to that point, Martin, you made, which is around, does ultimately come back to the preparers of financial statements to think about how do you express what you're doing in your accounts in simple language that people can understand and that are meaningful, which funny enough takes a lot of work to do, actually. Just put complex business issues and complex accounting standard requirements simply, but I think it's really important to the market and good quality reporting.
Yeah, I mean, I think if you read a revenue accounting policy, if you read, a lot of them are just boilerplate talking about the 5 steps. It tells you nothing. What you really want to see is, as you've said, like actual, something that's specific to what the company actually does. Definitely so much more helpful. Yeah.
So I think that ends our panel specific discussion. So thank you very much to each of you. I think some really interesting points coming out of that. And we might come back to a couple of those, but for now we're moving on to the Q&A session. So please, participants, feel free to add your Q&As into the chat box or to the Q&A box.
Yep. Thanks very much to everybody there. And yes, as Alison has identified, this is now the opportunity for the registrants to be able to put their questions. Now they can pose their questions in a general sense, or they can direct them to a particular panel member, or they could direct them to the research team if they have a question of the research team. So certainly encourage there to do that, and hopefully we'll start seeing that Q&A. That Q&A section populating. But I can see there is a question there that is directed to Tracy from Neil. And Tracy, if you identified that you'd be comfortable to answer that, would you be happy for you to read? Would you like to read, given that you're going to answer, would you like to just read what the question is, so that I think everybody can see it, but perhaps you might just like to Tracy what that question is.
Sure. So the question is around whether IFRS 15 provided more support for the auditor discussing revenue recognition with companies on issues around sort of identifying, separating the performance obligations in contracts. I think Neil has asked for a specific focus on residential property development. Well, he's giving that as an example, but I mean, I think in general, IFRS 15 definitely around implementation, definitely, and ongoing, made us look and consider and have those discussions with the client about what were those performance obligations within each contract and make sure that those were being identified. It definitely, I think, providing an opportunity and is ongoing, providing an opportunity to have more robust discussions around revenue. As I mentioned before, there are a lot of estimates that are required within the standard. So again, as an auditor, you're going to be spending a lot more time on areas where there's estimates and potential, variable outcomes, because that requires you to make judgments and have more information in order for you to be happy with those judgments that have been made. So yes, I think that IFRS 15 has definitely driven that, because the previous standard, AASB 118, it was just just provided no guidance. And in a lot of industries previously, to be honest, people were looking to US GAAP where there was guidance, especially around in technology businesses. So in those kind of industries, this was already an ongoing discussion, but I think it has created more discussion in other industries where there was less robust thought about those performance obligations.
I think one of the other observations I'd add on there was where previously standards were adopted almost at a local level, these new global standards in 15 and 16 have really led to global interpretation and practice. Mm-hmm. And there's, I don't know, Tracy, if you agree with this, but probably less ability to have as much judgment within a jurisdictional level. And it's that because you have to be conscious of all the global interpretations that have been going on. And keeping track of all of that is quite extensive.
Yeah, absolutely. And now, because IFRS 15 is aligned to US GAAP as well, again, where you've got companies that are comparing their results to US companies as well as across the rest of the world, then again, that requires alignment, like you say.
Yeah.
Yeah.
David, you had a very astute comment around the issues was very much around exceptions and difficult areas, the areas that took lots of judgment, particularly around principal agents, and we saw that with a few Google, Amazon, some of the ride share companies, Simic Divine on the construction companies, variation and disputes, where I think previously there was, certainly on principal agent, there was guidance, but probably not quite as prescriptive as it's come, but it's still open to judgment. And on the contract variations, certainly definitely more prescriptive guidance than there was, or different guidance than there was previously.
I think Simic in absolute dollar terms had the largest impact from AASB 15 as they de-recognised a bunch of retained earnings.
And Martin, maybe I'm putting you a bit on the spot there, but do you think that was a good thing in terms of the adoption of 15? Do you think the 15 requirements got them to the right answer?
I haven't seen lots of cash coming in with no matching revenue or re-recognition of that yes, is the short answer. You haven't seen anything in those accounts subsequently to make you think you were forced to de-recognise revenue that you've just subsequently got. It looks like that was revenue that didn't exist.
And I think that shows that there were some good changes, but as David said, they certainly weren't easy to apply and were difficult to interpret. And I think principal agent is going to be one that continues where there's such a level of judgment as to how to make that assessment.
Yeah, one of the very few public disputes between an auditor and their client in listed company land in the last several years was over that principal agent relationship at Webjet, I think it was, around classification of particular arrangement.
David,
sorry, I was just going to say on principal agent, I just think that's going to come up more and more frequently because, sort of mentioning before, just in this technology world, what you're seeing is just more and more complex contracts and like partnership style agreements between businesses and technology suppliers. Like if you look at, a contract with an Amazon Web Services, for example, that lots of businesses would be using, it's not, like the banks could be using them. Lots of these contracts, they are incredibly complicated and it's very hard to discern whether they're principal or agent arrangements. So I think, that's going to be interesting moving forward.
And to your point about the standards being outdated, I think those standards were very much written from a agent principal inventory type. You've got a physical good where you're selling and are you the agent in the middle? Whereas I think what we've seen more and more is service contracts, and trying to assess actually becomes quite difficult. David, yes, I think you've highlighted probably one of the biggest impacts around Rolls-Royce and their early adoption, and they did quite a few press announcements on what that would do, because they needed to separate out the sale of the engines from the sale of the service contracts, and that meant actually seeing in some cases the loss leader was actually recognised then under 15 as a loss. Definitely one of the biggest ones. I'm not sure whether anybody in the panel had any reactions to Rolls-Royce's announcements. Certainly, I think sparked a lot of debate globally from the accounting fraternity as to the accounting and the issues that were attached to that. And before they got to that position, there'd been principal debates around how did you apply 15 in those circumstances.
The most unexpected impact I saw from the standard was ASX having to recognise as deferred revenue fees for listing, and had to come up with an arbitrary length of the listing life to recognise them over. That was the weirdest and most unforeseen impact that I can recall.
Yeah, that's another tough one where you have to estimate the contract life when it's open-ended. Yeah, it's hard.
It made very little difference, but it was just really quite peculiar as an example of the implementation of the standard.
Helen, thank you very much for your comments. The team will take those on board and see what we can do and come back to you. Thank you very much for your comments, Peter and Sebastian, in terms of enjoying the excellent presentation. Peter, Sebastian, question for you around, did you look at the disaggregation of revenue expenses, which is something that has come up quite a lot in this discussion?
Probably the one area where I think Martin and Sean are on exactly the same page is that the additional disclosures were limited to how you accounted for the revenues, and there was no requirement to quantify it. And if there had been quantification, it would have allowed for, I think, more meaningful analysis of the financial statements. So I'd say that Martin and Sean are exactly the same page there. Some companies did provide it voluntarily, but it wasn't prescribed by the standard. So if that was more widespread, that would have been a positive thing. So I think that's the first point. The second point I'd probably reiterate is that the firms adopting with minimal transition disclosures was a problem for us from a research point of view. And I think it's also a problem for users. And if that was dictated by materiality, then that would lead to, I think, a lot better outcome for users of financial statements. And I think the third point, which I'd probably pick up on, which is something that I think has emerged in the comments from Tracy, Martin, and also from David's questions, was that when you have accounting standards which sort of sit on the shelf unchanged for 20 years, then they become obsolete, and that maybe we need to be more proactive in terms of evolving accounting standards to adjust to changing circumstances rather than waiting for a new accounting standard to address all the sins of the past. And so that's why I'd probably advocate much more for an evolution process of updating accounting standards. And it also picks on the comment that the impacts of this new accounting standard were limited in terms of the firms that they impacted, but maybe that would have been better addressed by having additional guidance added into the existing accounting standards if they were updated on a more progressive basis. So that's probably what I feel from having done the research and from having listened to the comments today.
I don't think we have any other comments. I guess, Martin, you spoke about that you'd like the standard setter to look at whether the capitalization of interest is appropriate. Were there any other areas from any of the panelists around other areas that need significant change, that were actually problematic and aren't working? No? No? Okay, good one. That's an interesting test. I think there are obviously a lot of it is now around the interpretation and how it stays current in the context of the environment that we're in. Peter, were there any other observations from you?
I think that was the major points. The transition disclosures were poor for many firms with material impacts. And that really impacted our ability, and I think it would have flowed through to users as well. So those are the major ones. That's a major issue for me.
Yes, and I think for us as I think for companies and auditors just going forward, it's going to be really important for everybody to stay up to date with all the interpretations that are coming forward, and making sure that all new contracts are entered into are actually assessed according to all the updated guidance, which is quite challenging given that the world is changing quite quickly and there's still a lot of discussion around the interpretation. And I think for me, it'll be interesting to see how the IASB, through their post-implementation review, actually enable effective sharing of some of that guidance and interpretation to make it easier for companies, because I think it's actually got very hard because of the extent of the guidance.
Yeah, I think that's right, Alison. I think with all the guidance that's out there, people do feel nervous that they, didn't read, might not have read something that was on page 562 and misinterpreted something. So, yeah.
David had another question, which I think is an interesting one. I think we'll probably have a few views on that, is if the standard set actually hadn't used the modified retrospective or allowed the modified retrospective approach, would companies have been able to do comparative amounts, given that numbers still went with modified, even though they had significant time to implement? I think that's a really interesting challenge. Anybody want to take that one? I mean, my perspective on that one would have been, I think for those companies with really long-term contracts, that could have been a real challenge. And so I think it was actually probably I actually think the cumulative catch-up or modified retrospective was quite good from that perspective. It balanced the useful information with the cost, and then added the disclosures to try and show what the impact was in the current year that was adopted. And while in the first year maybe that wasn't ideal, once you move to the second year, you start to get that comparative trend. So I'm not sure, David, that companies would necessarily have. I mean, you can always get there, but it would have been a lot more work, and whether the value would necessarily have been there, I'm not entirely sure. There's a lot for corporates to do at the moment, and adding extra costs is not always the right thing to do.
Yeah, I agree. I just think that, I mean, if there's one transition method, I just think that's the way to go, because you've got the first year impact, you disclose what the impact is, and then everybody moves on. But I just think it's modified retrospective, like a cumulative catch-up is fine if everyone's doing the same thing and it's just a one-off in the year, because it's understandable. So I just think it's clearer to keep it as not being optional, having one method to transition.
I think just before we finish the Q&A, are there any closing comments that any of the panelists would like to make?
Alison, Sean, it's related to this, but not specific to it, and that is the research largely focused on earnings. And I suppose, ASIC has some concerns regarding non-IFRS financial information where there's no standardized definition. I mean, it can be useful in many instances for investors to have that information, but there is always the risk, as we've pointed out in our Reg Guide 230, that non-IFRS financial information may have the potential to be misleading, and therefore, there are issues around prominence and reconciliation that we would call out as well. Thank you very much.
Thank you, Sean.
Yeah, I'd like to echo that, and this is directly related to the revenue standard, but, well, it's related in the same way that siblings separated at birth or who have never met each other are related, in that they have something to do with each other, but not a lot. And so annualized contract value, the number of different definitions of that floating around at the moment is quite remarkable. There are some companies that are doing it annualized based on the last week. And then there are others who are doing it in what I think most people would understand annualized contract value to me. But yeah, it's for companies that are being, the research, as I understand it, basically excluded loss-making and high PE companies as just being companies where earning signals don't have a lot of impact, which is clearly the case. As a fund manager said to me once, yeah, all this earnings quality stuff never matters until it does. And those companies are actually ones that have, in the current environment with revenue multiples, an enormous incentive to be grabbing every single dollar of revenue or ACV that they possibly can. It's always interesting when there's a big gap between your ACV and your actual revenue.
That's a really good point, Martin. I think because, again, as I just discussed before with there's been a spate of recent IPOs, and a lot of those have been in the tech space, and this is like, the recurring revenue, total contract value, this is all over the place right now. So yeah, making sure that those are clearly defined, I think, is important, because the revenue standard is properly disclosed, all the disclosures are included, because that's kind of what's driving the prices of those businesses right now.
The challenge with those, it's actually not current revenues, it's future revenues. So, and people's estimate of their future revenue. So I'm not quite sure that's going to be captured by AASB 15 either.
Oh no, it's more
market discipline. Quite ultimately, both from a kind of ASIC has a role to play.
Presentation, yeah.
ASX has a role to play, and also just investors who eventually punish people who keep making claims about their revenue that are ultimately not.
Well, thank you to each of you today. I think there were some sort of fairly consistent messages in many ways. I think, Peter, a couple of things I heard from you were that it is important to have time for entities to transition from a systems perspective, where you have complex changes. Question around where you've got two transition methods. Should we just have one for consistency, or should there be one where it's which is retrospective, where the impacts are material, and how do you build that in? And I think, Martin, that was something you were supportive as well. I think in terms of disclosures, disaggregation of revenue and making sure the policies line up with those disaggregated disclosures, and then in terms of making sure that you tell the companies tell their story appropriately, which links into Sean, the point you made now around non-IFRS measures and the making sure they're appropriately defined, and that there's good discipline around how those numbers are actually calculated, so that they're not misleading to the market. So many other things I think I could rattle off the top of my head, but thank you very much to each of you today for your insights. And I'll now hand over to Al.
Thank you, Alison. Thanks everyone for joining us today, and thanks very much for the great presentation and the discussion. I hope you all have enjoyed it. So as you may be aware of, that the AASB is expected to commence the post-implementation reviews of IFRS 15 shortly. And part of the PIR process is to gathering and considering academic research, particularly where it provides evidence that could help us to assess whether the outcome of the standard sightings are in line with the expectations. So on slides, you can see some of the potential research opportunities as identified by the AASB earlier of the year. So we will have a quick polling questions open for everyone. If you are interested to learn more about the potential research opportunities related to the IFRS 15 PIR, it would be great if you click yes, and we will contact you in due course when more information becomes available. At the same time, we are also keen to hear any comments, feedbacks from the practitioners as well. So if you would like us to follow up with you for some further questions, please click yes as well. And you may reach out to us directly as well by emailing to research@aasb.gov.au. Thank you very much, and we will keep this polling question here for the next 5 to 10 minutes. And I believe now is the time for another break. I will just hand back to Mark. Thank you.
Thank you, Al, and thank you to the panel and the presenters. Very interesting. Think. And the point about the entity telling its story, and then what we heard about I suppose the quality of the disclosures, the two things, there didn't seem to be a good marriage of that in terms of that storytelling and that level of disclosure. But certainly there was identified there some entities that some of the researchers might be interested in having a look at, and or particular industries. And I'd certainly encourage you, both the academic researchers, but also practitioners, that the engagement in the post-implementation review process will be I think very important, given that IFRS 15 has such a broad application, and we heard how with the change in the way in which business is done to that more service focus, and therefore questions about matters such as principal and agent are focused in that particular direction, as opposed to the more traditional where there was a product involved. So look, we're finishing there, and we'll be rejoining at 12:30 p.m. Australian Eastern Daylight Time. That's when our next presentation will be, and so if you could join us just a few minutes before that. And the focus of that next presentation is using an experimental design to look at other comprehensive income, the labelling of other comprehensive income, and the meaning of that to non-professional investors. So thank you for having joined us this morning, and we'll look forward to rejoining just after 12:25 p.m. Australian Eastern Daylight Time. Thank you.